Hi everyone, hopefully you're having a good day. My name's Andy, my channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's just dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these topics and subjects, looking for potential investment opportunities, sharing them with everyone in the community. I do that with Q&A sessions on the weekends, midweek updates for Tuesday, Wednesday, for release dates, and that's how I communicate with everyone. If that sounds interesting, definitely try it out. Special is a coupon code where you can save 50% off the first month only on a monthly membership and a larger discount on the yearly membership. And you can always swap from a monthly to a yearly. So starting off with Grady, the signal was 5 years ago at the start of the commodities bull market. This is a sweet looking chart. Look at this thing. We're squeezing up here, and then you can see a false breakout before the big move higher. And this is looking for the mother of all commodities around the apex moves. This is buying when there's fear in the market, when people are scared. That's just how much of an extra value you get. Now, would I have guessed that we would have dropped like this before C19 came? I wouldn't have guessed that. And then when C19 came, I still wouldn't have guessed that they would have shut down the economy. I would have not have guessed that. But that was a pretty big move that gave us ridiculously good entry points for a variety of different things. Now, that is behind us, but you can learn from history. You can learn what it takes to buy bottoms, and you can apply what it takes to buy this type of fear bottom, and you can apply that to today. Generally, bottoms are made when people are not interested, very low sentiment, and no one's looking. Sometimes it's driven out of fear in the market, like C19 event. Now, can we predict or project these types? Some people call them false flag events or something like that. I don't know if you can. I think it's very difficult. But the ability not to sell what's undervalued and to buy more when it's cheap, I think that's what you want to walk away with. It's how do I take advantage of the situation when assets get even cheaper from an already cheap place against the value of that asset. Oh, looks like I hit the wrong thing there. Coming back. Oil to silver ratio. I like doing all these ratios. I think that when you price an asset versus an asset compared to history, that it tells you something. It tells you the relative valuation in relationship to history. So we've got this big falling wedge here that we've broken out in 2022, and then we have a consolidation on top of it. We're still on that consolidation. What does this mean? Why does it even matter? Well, this is my opinion, and it doesn't mean that my opinion is 100% right, but this is what I think. I think that we were in a falling oil price to silver ratio all the way to the bottom of 2020. When 2020 occurred, we went into a bull market and we broke out of this falling wedge to an era where I think oil could outperform a lot of different asset classes out in the future. Now, that hasn't occurred yet in terms of breaking out of all of these patterns completely. We had a breakout. That's step one. Step two is the retest, which we're doing. We're in the retest. Then when this breaks out, those that are positioned in crude oil and energy service companies are going to have one heck of a party. One heck of a party. If you zoom in on the right-hand side, that's zooming in on that right-hand candle. You can see we're squeezing into that corner there. And I don't know if I drew this perfect. So if it's below it, above it, it doesn't really matter. A lot of people, they look at things. They're like, oh, he didn't draw it perfectly. It doesn't matter, guys. I've looked at so many damn charts. If you're that nitpicky, you got to figure something out. That it's not about having the right line or the right kind of area. Um, I used to be that way when I first started doing this, nitpicky about lines and how clean things were. It just doesn't matter. If you know the overall cycle, you know that you're cheap, you know that the tailwinds are behind you, you shouldn't be that picky. What we're looking for is just a squeeze into a corner. And a lot of people, I mean, I think silver, we could even see a false breakdown here before it breaks higher. Totally possible. I'm not saying it's not possible. But I think out in the future, I think crude oil could outperform most things. Um, the 1970s bull market, crude oil did not outperform silver. It did not do that. Is this some sort of different market condition that's coming? I'm not exactly sure. I don't know. But I'm not going to put all my money in one basket. I own silver, I own crude oil, I own a little bit of gold and platinum. I own across the board in case I am wrong. But I think the right market conditions are coming where all these are going to go up together. I just don't know how much precisely. Now, some people say, oh, you don't know how much. It's like, guys, no one does. Don't give me that crap. No one knows with precision. Everyone's trying to make guesswork. We're trying to look at potential ratios like this one is still cheap in relationship to silver. Crude oil is, if compared to silver at least, is the cheapest it's been through all of this, going all the way back to the 1980s. It's never been this cheap. To see the dotted red line going across there, I mean, this is a heck of an opportunity. Heck, outside of this event here, I'm not including that, but I'm just saying before 2020, it's never been this cheap. That's called an opportunity. Warren Buffett says, an ability to detach yourself from the crowd. I don't know to what extent that's innate or to what extent that's learned, but that's a quality you need. You do need that. Do you know why? Why do you need that? Because that's how you buy bottoms. You're going to be going against everyone else, and that's how you sell tops. It's the ability to objectively see everyone else acting like fools on both sides of the coin, on the upside and on the downside. And you have to act differently than everyone else. So you can't become part of the herd. You can't fall victim to these cliques or whatever you want to call it. Can't fall victim to society. You got to stand apart. And that's where the best entry points are. And that's when you got to sell. When everybody else is super excited and they think that it's going to go to the moon, you got to say, all right, take my shares. I've done a pretty good job of doing this myself. I'm not exactly sure if I think it's partially learned and it's also partially innate. I think it's both. I never had a this was my problem. If you in my opinion, my problem growing up was that I thought people were smarter than what they actually were. So I thought that people were a lot smarter in comparison to what I am and was. So I had this, I'll say it like underconfidence, not overconfidence. Like it was like I was more introvert and I didn't have the confidence because I thought others were smarter than what they really were. It took some years to figure out that people weren't as smart as I thought they were. And that started at work. It started at school. That was the first. It was school, then work. And then I started to figure out like people didn't know what the hell they were doing. And then I was like, okay, now I understand. That probably I figured that out later 20s. And then after that, it was really easy to separate myself from everyone else. It was very easy. Um, I would just say, you know what, these people know what the hell they're talking about. I used to think they did, but now I'm like, no, they don't know what the hell they're talking about. So then it's easy. It's easy to separate yourself. The hard part is to find who the heck you can learn from. Because if everyone's just flapping their jaw, saying a bunch of stuff that doesn't make any sense, or they pretend that they know what's going to happen, they know what's going to occur, and that's when you want to just say, you know what, they don't. So you detach yourself and you create your own strategy that works. Now, some people say there's You need to create a strategy that works for you. I'm just going to say this. There are superior strategies and there are strategies that just do not work. And I think very few strategies are exceptional in terms of deploying strategies in the financial markets. One of them is being able to detach yourself and then buying bottoms and holding. But that requires a whole bunch of traits that most people cannot do. Traits like just being able to sit there and do nothing. Traits of buying at bottoms when everyone else is telling you you're stupid. Traits where uh, you can, you know, and understand that prices are detached from the business. There's a detachment there. So if you can understand that there's a detachment, if you can understand that you can use technicals to see how people are positioning, if you can separate yourself from the crowd and you can be patient while everyone else is impatient, then you can dominate the market, so to speak, because you're not influenced by anyone else. Everyone else is going to tell you it's dumb because you are taking advantage of their impatience and you're doing that through your patience yourself, and that's when you dominate. But very few people can separate themselves from the crowd. I said no one is looking. That is when money is made. Crude oil versus gold. And I've got a chart here of a falling wedge, breakout, falling wedge. It looks like a shoulder, head, shoulder, bottom, and we're on the right hand shoulder. And you're going to have a whole bunch of people tell you that you're wrong. Oh, what's oil doing? Oh, it's not in a commodity super cycle. It's not going up. It's like, yeah, we've broken the falling wedge to the upside and we've done a retest. Look, I bet there's probably a bunch of people saying it or going to say it soon. And then you're going to have the falling wedge here with a little bit of a false breakdown and looks like we're trying to put in a double bottom or something like that. And maybe it's not completely done. Maybe we have a little bit further to go lower before going higher. Why do I say that? Maybe gold has some, move higher than it needs to complete. Maybe it has another breakout. Maybe silver. Maybe they print money and that's when it draws gold higher and silver higher. We get a little bit move lower. Maybe there's a false flag event. There's all sorts of things that could potentially come that I don't know about. Maybe the event was Liberation Day. Maybe that was the event that yanked everything lower, and now we're going to move up from here. I don't know. A lot of people think they know this. I disagree. Maybe the event already occurred and it's behind us called Liberation Day. It's possible. Platinum to gold ratio update. So here's platinum to gold. You can see it's way down here, super cheap in relationship to history. That's going back to 1980s back here. 1980s. Now, if you zoom in on the right-hand side, you can see we hit our head on resistance, we pulled on back, and we're going to try to break out of this resistance line going across. And then we're going to enter what I think is going to be an outperformance of inflation assets when that occurs. And it could occur at any second. We also have a platinum to silver ratio, another update. We had a falling wedge and we broke out of the wedge on the right-hand side. So if you zoom in on the right-hand side, that's what it looks like. A breakout, and then we've got a retest. Ooh, this is looking good. Now, I know everybody is watching silver. I know everybody is, they're all about silver and silver mining companies. I get it. So am I. I think they're going to do well. But what if platinum does a lap around silver as silver is flying higher? What if platinum just does some ridiculous move? That's possible. And I am positioned for both of them to do well. Another thing about positioning, I mean, just to kind of talk off the top of the head here, you don't need to win with all of your money. And yes, I understand if you chose the best asset, put all your money in the best asset, that you're going to have the best return. I understand that. I'm not dumb. But is it possible to choose what the best asset is if you've got, let's say, 6 or 7 different assets? So rather than putting all my money in one, I ask myself, well, how much money do I need in each of them to change my life? then that would give me a higher percent likelihood of being successful. So it doesn't mean that if I choose right with all my money in one sector, and if it were to play out, I would make a whole bunch of money. So I'll be like, okay, that's awesome. That's great. Now, what if I put my money diversified across 6 or 7 different asset classes? And let's say that the probability of one of those asset classes of the 6 or 7 is going to return so ridiculous that it would change my life if I had some money in it. So then I'd say, okay, well, what is this? What is some money? So let's just hypothetically say that if I put money across 5 or 6 different asset classes, and let's say if it's 5 asset classes, it's 20% in each asset class, just making the math super easy. So it's roughly 20% across all these. And let's say life-changing money that you need to get some sort of amount in there. Let's call it like $50,000. So 50,000 times 5, well, that's $250,000. That's doable for someone my age. And if you saved your money your whole life, yeah, you could easily have that amount. So let's say you spread it across, you've got 50 grand in each, and let's say the sector itself, in some of these companies in the sectors do a 10 or 20x. Well, I mean, 50,000 into 500,000, yeah, that's getting up there. Now, obviously, if you put 250,000, you get a 10x, that's 2.5 million. Now, let's just say you play it across the board, and then you spread it across different asset classes and different sectors, and you start getting into larger and larger sums of money. So rather than 50,000, it's 500,000 in each of those sectors. And you get a 10x. Well, that's 5 million. So at some point, if you save enough money, you choose your companies wisely, and that's just with one sector doing well. I think you'll probably get 50 or 60% or more if you're buying these undervalued. And then eventually it starts to compound. All that money does. So the question isn't how do I maximize my returns and potentially miss out if something goes wrong in a sector or a company. It's about spreading it across, capturing the gains. And if the gains are acceptable for you to retire or get to your goals, then that's what you want to do. You want to increase your probability of an outcome while spreading across however many sectors to do that to get the outcome that you want. And if you get the outcome that you want, that is called being intelligent. It's called being smart. It's figuring out and deriving a way to get where you want to go. Now, I know some people, they don't have goals, so they just want to make the most amount of money possible. All I'm going to say is at some point in your life starts to degrade. I will say, like, not degrade. Uh, the gains become smaller and smaller after you reach a certain point. So if you live in a house and it's a very nice house and you're happy with the surroundings of the house, you're happy with the city that you live in, et cetera, et cetera, et cetera. To make yourself even happier, it's very difficult to push that needle. It may take copious amounts of money. So if you're content with what you have and you've made a decent amount of money, you don't have to bet the farm on one thing to try to make a kabillion dollars. It's not going to make you that much happier. So to understand all of this, like my thought and the way I look at the world, it's like, well, all I need is to get to my goals. And if I'm already happy with where I'm at, then I want to maintain that. And that's where I think you take the risk that's needed to where you need to where your goals are at. You don't want to take on more risk than necessary if you already are happy with where you're at. I guess that's what I'm saying. Michael says, or Mikal, Philly Fed, something to think about ahead of Jackson Hole, perhaps. And this is the USA PPI finished consumer goods ex food and energy. And this is the Philly Fed current prices paid. Look at the move higher here. That is way up. And the USA PPI follows that with a 7-month lag, leads by 7 months. Holy crap, we are entering an inflationary period here. This move here is big. I mean, look at the size of these moves here. But that was 2002, and notice that this could be 2002 coming on up. So this was 04, 05, 06, all the way up to 2008, 9. Man, this looks like a very similar setup to previous commodity bull markets. We're right there. This is fantastic if you're positioned in it. Buying the median priced home now requires $124,000 income, 57% above the current median $80,000 per Redfin. So this is Waleed, and it says at Grok is not, it's scary. An average earner can't even think of having his own. What happened in the last 25 years? Oh God. So Grok responds, it's a challenging reality for average earners. Over the past 25 years, U.S. home prices have risen 250%, while median incomes grew 90%, per sources like Econofact and Treasury. The main causes: demand exceeding supply due to underbuilding, zoning restrictions, population growth, and low rates boosting buying until recent hikes. Solutions like increasing supply are being discussed. So even Grok understands that we're in an expansion phase of real estate and that we are underbuilt. So a lot of people say, oh, no, the models are, we've got these models here and we're not underbuilt. It's like, no, we are. We're underbuilt, guys. Underbuilt. Insiders are buying oil and gas stocks aggressively. It's always good to know that insiders are loading the boat in the oil and gas space. And I love the oil and gas space, guys. The opportunities here are ridiculous. They are ridiculous because of the way that the companies are set up. They have infrastructure, they make money, they're cheap, and oil's cheap. I can't find anything in the market that has all of that combined. There's nothing. Uranium doesn't have it. It's not as cheap, and they don't make money. A lot of these precious metals companies, some are starting to make money, yes. A lot of them don't. There's a whole bunch of trash precious metals companies out there. But in oil and gas, there's a whole bunch that are just ridiculously good. I love it. Everyone wants to chase hype, but the biggest returns are made in industries nobody wants to touch. The next 10 years won't be about AI or crypto. They'll be about commodities. Yes. First wave, here comes it's the third wave. The second wave is the down wave for Elliott wave. But here comes the second wave of inflation, if you want to call it that. And that also matches this up here. That's also in agreement with this, which is also in agreement with what these guys are seeing in the insiders. So yeah, I agree. He's got a thread here. We can go into it. I don't know how long this thread is here. Let's do a quick check. Looks like he's got some charts here. So when commodity prices collapse, nobody wants to invest. Producers go bankrupt, supply shrinks, analysts stop covering the sector, capital dries up completely. This is the bear phase of the commodity cycle where patience is required. But underinvestment eventually bites. Supply gets too tight, prices rise, cash flow returns. Suddenly everybody wants in again. This is the bull phase. The problem though, by the time new supply comes online, the market is already oversupplied. Prices fall, producers slash capex, the cycle resets. That's the bust. Commodity cycles are long, often 8 to 15 years. The biggest challenge is not missing the turn. The worst thing is to get the thesis right, but never have the guts to pull the trigger. When bubbles pop, commodities shine. Dot-com bubble, S&P 500 goes down 40%, commodity index up 600%. The Nifty 50 bubble goes down minus 48%, commodity index up 300%. In other words, even if you wait for a recession to happen, chances are you're still going to miss the boat. And that is if a recession happens. Show me someone who reliably predicts recessions, and I will show you a liar. The risk is not a potential recession, but not participating in the bull market. Hey, this guy sounds like me. Right now, we are in a commodity bull phase, but nobody cares. AI dominates headlines. Crypto sucks in speculative flows. Analysts ignore energy and metals, capex is declining. History shows that's exactly when commodities quietly outperform. Commodity producer capex cycle going down with capex. Year over year change, it's very low. Most people need rising prices before they believe in a thesis. By then, the easy money is already gone. Commodity cycles punish the impatient, but those who buy when everyone else has given up don't just survive the cycle, they get rich from it. Exactly. If one wants more macro, blah, 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 okay, I get it. That is good. This is the Danish Kruger, however you pronounce that. Kroner, Kruger, whatever it is. Shoulder, head, shoulder in their yields in a potential breakout here. Look at that. That's ready to break out to the upside for 30-year yields. DK 30-year yields. Man, that looks ready to rip. To the upside. To the upside. And that generally moves with inflation, guys. So we're seeing these patterns in yields that mimic or chase inflation. Inflation's coming, in my opinion. Investment wisdom, maximum panic usually coincides with minimum prices. Let's go up here. Is that right? Oh, it is. Maximum panic, minimum prices. That's the opportunity. Talked to a great friend today that's 58 years old and worth 2.7 million with his house paid off, and he's petrified. He doesn't have enough money to retire. 10 years ago, it's a no-brainer. He's fine. Today, it's harder. You got to cut back. That's how messed up things have gotten. I can't tell you how much money, I know how much I have a general rough area of what I'm probably worth or around. And I always question, is that enough? Do I have enough where I'll be okay if I don't have a job? I always question that. Is 2.7 million enough at 58 years old? I don't know. I really don't know. Because if you have massive inflation coming, I really don't know. So what I've done is I've locked in as much as I could on the cost side to reduce variability in my costs. So I don't rent, I purchase my house and I have a fixed rate 30-year mortgage. That's what I could do on the cost side. And then on the income, or I should say on the asset side, I have a bunch of assets that are inflation sensitive. If we don't have inflation, then crap doesn't go up and I'm okay. If we do have inflation, all my stuff goes up massively and I'm okay. That's the way I view it. Kind of the logic behind it. Garrett Goggins says it's called fiscal dominance and it's great for gold. Hasn't happened since World War II. It's marked by large budget deficits financed by printing money. It's happening worldwide because it's the only way to deal with large government debt. Trump and Bissett will get 1% rates and a lower USD. Nobody with a brain can hold the long end. It's a new era and few are prepared. I don't know if they can hold those rates down. I'm not 100% in that camp. I mean, they can hold the short end of the curve down, but I don't know about the long end unless they do quantitative easing, and then the dollar is just going to get absolutely vaporized. Then my inflation sensitive assets go to the moon. So SIL versus silver, which is the futures pricing. You can see a breakout here. Look at that breakout. So we've got SIL versus silver, the ETF that is, breaking out here. It looks fantastic. Peter Lynch says, whatever method you use to pick stocks, your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. It isn't the head, but the stomach that determines the fate of the stock picker. And I see a lot of people on the Discord that we've got. They worry about short-term price movements. They get all worked up about short-term price movements. You can't be that way. You need to separate price and value, separate sector value and price, and say the value is there irrespective of what price is doing. Price is not a determining, it doesn't determine if something is right or wrong. It only is what an extension of what people think at that current second. And that current second could be emotionally driven, it could be anything. And you have to separate those two. Grady says posted on the platinum and palladium was about to move big, plus start their bull markets. That is now happening. The PGM bull market will be a complete animal. And now we have platinum below breaking out versus the SPX. This is one further evidence that a historical asset rotation is in the making towards precious metals. Many have now woken up to platinum and palladium, but go with us. I've played these sectors for decades. So this is platinum versus SPX. You can see the breakout of this falling wedge and a potential retest here. Guys, if you're part of the website that we're on, you know we're positioned in this. We are playing it from all fronts, and we are going to win this thing, guys. It's going to be a fun as heck ride together. Platinum breaking out here. Again, it doesn't mean it will go straight up. It doesn't mean that it will go immediately. What we're seeing is a big shift in the market underneath us. So platinum most likely, and silver and gold and all the rest are going to outperform for a very long time. And platinum is possible with the ratio being the cheapest against all the other metals. And with what I've seen in history, could outperform everything. Now, does that mean 100% that I know that? No, it doesn't mean that. That's why I say could. That's why it's one sector in a group that we are exposed to. So platinum looks ridiculous. It is the cheapest. Palladium was the cheapest in 2009. Rhodium was the cheapest in 2016. In 2000, gold and silver were both very cheap against platinum and palladium and rhodium. And to understand that gives you a leg up on everyone else. To understand these charts, to understand what's cheap and what's expensive, to avoid what's expensive, to allocate to the biggest potential upside returns when things are cheap. Aramco, market fundamentals remain strong, and we anticipate oil demand in the second half of 2025 to be more than 2 million barrels per day higher than the first half. Holy crap! 2 million barrels per day higher than the first half? Maybe we're putting in a bottom of oil soon. Maybe we already put it in. Tough to say. But demand continues to remain robust. Do you know what that demand is? Scroll up here. That demand is called fiscal dominance. And it's happening everywhere, worldwide. Worldwide fiscal dominance is the demand for oil. Just make sure you understand that. Freight Futures AM update. Dry bulk. Capesize is flat. Panamax up 1%. Tankers, VLCCs flat. Suezmax is down 2%. Here's one from Grady. He says, to get out of the rat race, one needs hard work, strategy, stamina, mental balance, discipline, huge sacrifices, maximizing income, minimizing consumption, and to bet on the right market. This chart is setting up again and gives you which market to go for. Commodities versus the stock market, double bottom. And we're going to come out of this. His opinion, the chart has that preparing for a slingshot look. I like that he's using slingshot. When this ratio moves up, commodities outperform the stock market 36x. Now, obviously, the stock market could come down, and commodities are going to go way up. And when I saw last commodity bull market, which was this little move here, it was from 2000 to 2008. This is what's coming, guys. This was the last commodity bull market. Remember I said before, with the increasing interest rate environment, it's not like 2000 to 2008, which was in a declining interest rate environment. What's coming next is going to be like, it's like a game-ending move, guys. It's like you either have assets and commodities or you're screwed. It's suggesting that financial assets are about to have a big problem. And I don't know where Bitcoin lies in that, too. A lot of people say, Andy, I know you don't own Bitcoin. I think it's a financial asset. It's possible that it trades with the U.S. stock market. And commodities and precious metals go up like they have in the past. and protected yourself against currency debasement. And when people figure out that financial assets aren't going to protect them in this large inflationary environment, we'll see how money rotates. All that money and financial assets are going to have to rotate back into precious metals and commodities at some point. That's kind of what I think is going to occur. It's coming. But that's where I'm going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special coupon code. And that's all I've got for today. We've got a Sunday question and answer session coming up, 5 p.m. Mountain Time. See you guys there. See ya.